This podcast is for informational purposes only and is not an offer or solicitation of an offer to buy or sell securities. SNN Network, SNN Inc., and the Planet MicroCap podcast and the representatives are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome to the Planet MicroCap podcast. I'm your host, Robert Kraft. Thank you all so much for the support and for tuning in. If you like what you hear on the Planet MicroCap podcast, please take a moment to rate us 5 stars on Spotify or Apple Podcasts. It really helps more folks discover the show and join the MicroCap investing community. Registration is now open for the Planet MicroCap Showcase Toronto in partnership with MicroCap Club, taking place October 21 through 23, 2025 at the Arcadian Loft in downtown Toronto. Whether you're a seasoned investor or just getting started, you'll want to be there. Visit planetmicrocapshowcase.com to register and see you in Toronto. My guest on the show today is Jerome, portfolio manager at Uzo Capital. Jerome brings a unique lens to public equity investing, shaped by his experience on the equity trading floor at Merrill Lynch during the financial crisis, his global perspective, and a profitable venture in music royalties. In this episode, we dive into Jerome's barbell investing approach, pairing stable, cash-generative compounders with higher risk, venture-style bets in the public markets. He walks us through how he identifies asymmetric opportunities where the upside far outweighs the downside, particularly in companies that are either undiscovered or undergoing transformational change. Jerome also shares how his music royalty business, which generates steady recurring cash flow, provides the emotional and financial runway to take bold swings on high-risk, high-reward ideas. He discusses how this foundation enables him to withstand volatility and dig deeper into ideas that others may overlook. We cover a lot in this conversation, from investing ideas like PLBY, McCoy Global, and Comstock, to his thesis around durable capital-like growth businesses and the importance of identifying free call options within complex situations. Jerome also lays out a thoughtful framework for due diligence and portfolio sizing that helps manage both risk and conviction. And for full disclosure, we discuss a number of companies in today's conversation. I am not a shareholder in any of them. Thank you again for tuning into the Planet MicroCap podcast, and please enjoy my conversation with Jerome, portfolio manager at Uzo Capital. Jerome, thank you for joining me today. How you doing, man?
Very well, thank you. And yourself?
Oh, just another nice. We're recording this on what's today? Tuesday, the June 10th, 2025, and listen, I'm just happy to get you on here, man. I mean, look, quick background. Like, I think we had the best first meeting ever. In my opinion. I don't know if you felt the same way, but I was like very much like, dude, this guy's awesome. But I remember right before you signed up for our Vegas 24 event, and yeah. I think you weren't planning initially on coming. You saw the list, you're like, all right, screw it. And then you told me the whole story, like, oh, I was going to a bachelor party, and I thought, why not? Like, let's go and check out this MicroCap conference. And now we're best friends. I mean, big, it's no big deal.
Right on. In fact, I was one of the companies in the conference. I was flying to Vancouver to try and meet with them, and they said, "Oh, we won't be able to meet you, but we'll be. By any chance, you're going to be in Vegas for the Planet MicroCap conference?" And I said, "Well, I'm not signed up, but I can be. I'm going to be in Vegas, so let's meet there." and I came again this year. It's fantastic. So thank you for putting it on.
Heck yeah, no, it was awesome, and thank you again for coming. And the reason I wanted to have you on, not only just to announce to our world our best friendship and whatnot, but it's really now that a number of investors have met you, they put a face to the name from Twitter X, but a number of companies have met you. I was like, you know what? I'm sure everyone's like, what's I get asked all the time, like, yo, what's Jerome's background? Like, what's his deal? What's going on here? I was like, I know a little bit, but I don't know all of it. So I figured, invite you on. Let's dig into your investing style, philosophy, how you got into it and everything, and then maybe cover a few names as well. So, I mean, let's start right there. Yeah, let's start right there. Where did your passion for investing begin? How'd you get started in all this?
Yeah, so I started if you go all the way back, when I was a little kid, I remember going to the bank with my dad and him explaining to me, well, we're going to be taking out money to buy shares in, I think, BAA, which I think they owned all the airports in the UK. So that was my first little taste of it. And then I think it was when I was at university, ended up doing an internship at Merrill Lynch, and I spent a lot of my career there on the equity trading floor in London and New York, advising mainly hedge funds, but also institutions about which companies in Europe they should be invested in. And I always really enjoyed it. For me, it was almost like educated gambling, and it was fun, and it was engaging, and but also I was very aware of there are emotional elements. It's not a spreadsheet maths game. There are all this stuff is, well, a lot of it's done by humans, and therefore there is a psychological component to it. And by coincidence, my first day on the desk was the day that Lehman Brothers went under and that Merrill Lynch got taken over by Bank of America. So it was definitely a baptism by fire, and it was a lot of fun. And I always really enjoyed it. The whole trying to find the interesting idea that other people hadn't caught hold of. And typically, what I found was that those ideas were within the mid-cap, small and mid-cap, albeit a lot of the client focus was on large caps, but those were where the names were a bit less discovered, or there was something drastically changing, where the biggest outsized returns were. So after I left the bank and effectively became a full-time investor, some of it in music stuff and some of it in listed equities, I really thought about where is the best bang for buck for risk reward and finding a symmetry. And typically what I found was it was in three buckets. It was predominantly in names which were undiscovered. And so they could be undiscovered because they are very small, MicroCap, small cap, or it could be that there's a big change. It's a Dispack transaction where it's effectively a new IPO that people aren't familiar with, or it's just flown under the radar for whatever reason. Or it could be that the company's going through a drastic change. But by and large, or it could be that the company's had a lot of near-term issues, but long-term things are great. This is a judgment call. But by and large, what I found was that there was a disproportionate a number of these interesting investment ideas, call it sub $1 billion, anything from 50 million to $1 billion. That's pretty much my sweet spot, but I'll go up to whatever market cap that I like, and I do invest at the higher end. But so I think that's really how we ended up meeting, because some of these companies would be attending these conferences, and I'd want to meet with them. I'm based in London. There's only so much you can do in terms of video calls. You can get a better feel from in-person meetings, and sometimes traveling to go to conferences is how you meet some of these undiscovered companies. In fact, every conference MicroCap conference that I've been to in the US or Canada, there's been a company there that I wasn't expecting to be that interesting, or someone said, "Oh, maybe you want to meet with them," and I said, "Fine, why not?" And there's always been a positive surprise. So that's sort of my journey all the way through to sort of meeting you.
Very cool. No, that's a great background right there. So, I mean, have you always had this global outlook? I mean, obviously you were looking at European companies. That was kind of your main gig over at Merrill Lynch. So you clearly have insights as what's going on, LSE, some of these European listed names. But I mean, were you also always kind of having, one door peeking over of like, oh, look at some of these Canadian and US?
Well, if reality is, if you're investing in Europe, you need to know what's going on with the US.
Fair enough. Yeah, that makes sense.
So I would say my expertise started out in Europe, and where I always invested with my own money, probably a lot more aggressively than most people. I would be maybe 50-50 between Europe and US. And then I moved from London to New York in 2015. And when I was based in New York, so you go from London, where you're speaking to these clients where the majority of their assets are based in Europe, to the US, where Europe is that much a small little bit. They're 90% in the US. So you really need to know what's going on in the US to also be able to frame what outside of the US might be of interest to them. So to give it some context, and this is also how I ended up getting into investing in music as well. Music was a big investment theme, but there was no listed company in the US. So there was Sony in Japan, and there was Vivendi, which owned Universal Music in Europe. So the big global hedge funds who were interested in the theme about the recovery in music, they had to go international. And so it was that sort of process, understanding the global themes. And there are ultimately, there's a lot of companies listed in the US. So I would say that I've always been developed market focused. So Europe, US, Canada, Australia, Israel, places where I sort of can understand what's going on and get my hands around it without having to worry about, a coup or something like that, or some sort of curveball emerging market thing that I've been, going to get caught off guard in, like Russia, which I have owned stuff in Russia previously before the invasion and didn't turn out well. So that's I will look globally, but disproportionately Europe and US and Canada.
Absolutely. I have to ask, you tell me how much you want to get into it or not, but on the music side of things, I know like we've talked a lot about it offline and whatnot. Do you want to talk about a little bit about,
happy to
focus on music and what you were looking for, what your thesis was there?
Yeah. So the thesis, let's say 10 years ago, was that streaming was growing a lot, and historically music's been killed by piracy, and they made all their money from downloads and physical, and that was dying. Where you moved to a subscription model, which was growing, there was a tipping point between subscription growing and all the other stuff falling. And it dawned on me that, hey, there's only three companies which control, call it 70 to 80% of music through all of time, and they're going to start growing again. And if you start getting money through streaming, the costs don't go up. You don't have to pay for all of the CDs and the vinyls to create them. And so I was instantly really interested if there was a growth story. And frankly, some of those attributes is what I look for in companies or situations on the investment equity side today. But so I was focused on it in the context of the day job, being a broker and advising clients. And then in 2020, sort of stumbled across being able to buy some of these assets directly, where from the songwriters themselves or the producers and so forth. And that became a side gig, which at some stage became bigger than the day job. And I thought, all right, now is the time to invest full time and focus on the music IP side of things. And obviously I do all the equity stuff as well. And so, yeah, it's been good. And I think that it was a learning curve that I enjoyed getting up the learning curve. And it was it felt quite entrepreneurial. I knew one other person who did something like this, who was based in LA, that I used to work with as at uni with, but it was getting up the learning curve and deploying capital and trying to make deals happen, which is what I do now, just sort of full time instead of it being a weekend hustle.
No, for sure. I mean, again, you tell me how much you're going to get into, because I know, look, our focus here, we're talking about, publicly traded equities and stuff like that, but it's a really interesting business. I mean, and also just the thesis around it. I mean, when it comes to managing basically a music royalty portfolio, I mean, how do you identify the right assets? What does actually running this kind of business really look like, on a day to day?
On a day to day. Look, I think there's two sides of it. There is one, which is a lot of the time is around finding the new deal flow, which is there's a deep network of connections and people, and it's almost like buying real estate. That's the best analogy. It's like buying real estate, but there's no right move, or I don't know what Street Easy, or I don't know what it is. What's the one in the US? I can't even remember now. Not Zoopla. Zillow. That's it. There's no Zillow.
It's no Zillow for royalties.
Yes,
I can already see my wife and I on instead of Zillow on our music for royalties Zillow app. Just like, oh, that's an interesting. Maybe that's an idea. I don't know. Anyways, sorry.
So a lot of it is finding new deals, analyzing doing the analysis on these portfolios, and putting in bids or trying to negotiate terms, structuring the contracts, etc., etc. It's very similar to buying a house. In fact, there's a lot of overlap in terms of how long these processes can take, and etc., etc. And then when you've bought it, it's like having rent, but there isn't really, the boiler doesn't break, but things can go wrong. So there's a degree of managing the things that you already have, and I would say there's two buckets. Some people that will operate on a big scale and are going to actively managing. They'll be buying rights, trying to place the song in adverts and things like that. And there's people who do it my way, which is a bit more passive. And I leave it to Sony, Universal, and these other characters to do all of that stuff. And I will collect the rent check after they've taken their fees and do it that way. But yeah, it's a good business, albeit it's you need to know what you're doing, because if you don't, you're probably the idiot in the room. And so yeah, and it's foolproof. The lawyers get paid a lot in this business.
I can imagine, dude. The lawyers, and then also on the managing the actual asset side. I mean, but hey, listen, if I were to do it, I would do the same way you are. Like, F that. Like, I'm not about to like hit up all these ad agencies and work with them. I'm like, okay,
yeah, that's a whole different
nightmare, dude.
Which I like the light touch approach, but
what is
you
were saying, like, you don't want to look like the idiot in the room when you're dealing with these. What does the idiot in the room look like when you're in those? Like, are they vastly overpaying? I mean,
well, sometimes you have people who are overpaid because idiot in the room, I use that term to describe someone who isn't informed enough. So sometimes there'll be very sentimental assets with common sense. So I remember seeing the rights to Star Trek come up, or so the music rights to the Star Trek stuff. I've seen the rights come up to DMX after he passed away, and I'm a big DMX fan, but I remember seeing all the streaming revenue had this massive spike. And I'm like, well, look, it spiked because he died and everyone wants to listen to his song. I'm not going to pay it over the odds for that asset just because it's DMX. So, but when I'm talking about the idiot in the room, it's more to do with someone who isn't aware of the risk that they're taking. So they may not understand the nuances around copyright law, where there are situations where someone can reclaim the rights at a certain stage in time, or that a lot of the earnings are tied to an earning stream which is one-off or it's unsustainable. So you need to understand some of these nuances to get a real feel for what the clean earnings are. A bit like a company, there's a one-off contract in there which is going to roll away. If you don't pick up on that, then you're the idiot in the room. And ironically, when I started, it was the other way around. I knew that is this change in regulation coming through where the royalty rates were going to go up a lot for some of these streaming royalty streams. So I realized that the earnings were going to go up 50% in some cases, and most people just thought, I only want to pay X multiple. And I thought, well, you know what, I don't mind paying a little bit more, because the earnings in 2 years are going to be at least 50% higher because of this component. So it's understanding those nuances, and sometimes it's to do with legal and copyright law. I think that was probably the biggest learning curve, was really getting my hands dirty on that side of things. Hence my comment on the lawyers.
Absolutely. No, look, one final question. Like, you tell me if you can answer this or not. Quick story time. Like, what was one deal that came through, or one rights thing that came up that, you were just like, damn, it's sick. Like, I got that. Like, this was, maybe not necessarily a sentimental one, but one that you're like, I really want that. Maybe I paid a little more, or I don't know. Just give me your most fun story in having done this thus far.
Yeah, so
that you can tell me, of course. That you want to tell me.
Yeah, no, I try to think now. The first deal that I did, actually, I bought the publishing rights for the Misfits. One of the ex-members of the Misfits was selling his publishing rights, and frankly, it was the first deal that I did, and I was getting up the learning curve, and I had a bit of backwards and forwards with him, and he sent me a really nice message. He just said, look, I really appreciate being able to get this deal done. It's allowed me to relaunch this new leg of my career. This is really transformational for me. And, that made me feel really good. And at the same time, I'm a massive Misfits fan, and there's something to be said for when you're streaming some of the songs you really like, where you're clipping, when you know that it's something that you own some of the economics in, and that's great. And so, but, there's there's plenty of these deals where I don't know the artist or know the music. I'm looking at the numbers and think, oh, this looks great. And there's plenty of deals where I really love the artist, but hey, I don't want to pay 50% more just because it's an artist that I really like. So that's if you can do both, it's perfect. But usually that doesn't necessarily happen.
So my final question for like whenever you're traveling or working out, do you have like, oh, here's my portfolio of rights that I own, playlists that I play as much as possible when because hey, you might get paid.
I did initially have.
did do that?
I did have a playlist, but because I was doing so many of these deals, and each deal that you do, there may be hundreds of songs in them. It was too difficult to keep adding all these songs. I was like, I haven't got the time to keep building the playlist of all the songs. So
it's so good. That is so good. I love that, man. I love it.
I think, and sometimes it would be a case of playing a song and. I don't know the artist, for instance, and I would speak to my partner and say, "Oh, I just bought this. We play it. Oh, Birthday Sex by Jeremiah. That's one of yours. Like, yeah, I've never heard of this guy, but whatever."
Oh, that's awesome. That's so good. Oh my goodness. Wow. That's so fun. It also speaks a little bit to the business itself too, right? Because I'm sure there's a number of folks out there that are just like, man, the economics are kick butt, but like maybe they're they don't even know anybody or aren't caught up on music at all.
Yeah, look, it's so there was actually I remember this is a slightly funny one.
Okay.
There was this big 1980s Bollywood catalog which I ended up buying with a few years ago, but Bollywood music I'm not very familiar with, and most people probably thought it's most of the earnings are in India, etc., etc. But I thought, hey, it's super cheap and it's really old music. If people are listening to it 40 years later, they're probably going to listen to it in 41 years, etc., etc. Anyway, so I that year I was on sabbatical from work, and I think I went to Antarctica of all places. So I was on this cruise to Antarctica and was talking to this guy and who was Indian, and because he had this app where a lot of the streaming money would come from. I said, "Oh yeah, do you know these artists?" And he was like, "Jerome, these people, this is like Prince, Michael Jackson, and Madonna of India, like from 40 years ago." So I had no idea.
Nice. So you're like trying not to puke on the Drake passage, like, oh, sick, like, oh,
great.
Like, you just made me feel a lot better after my second Dramamine. Like, this is great.
Yeah, exactly. So I felt pretty good about that.
Oh, that's hilarious. I love that, man. All right, cool. All right, so we covered music worlds. I had to ask you all these things. Like we're running around in Vegas, like we never got to go on that. So I knew it was gonna be a fun one. But going back to the equity side things, I've went through some of your tweets, some of the threads and stuff like that. And one of the things that was interesting, or you put out a thread, you had like your Uzo Capital thread of your core thesis. You put that out on May 21st, 2024. Kind of your core thesis is high margin, capital light, durable growth businesses are ideal. I mean, go figure, right? Like you love music royalties. This is like that in one sentence. And I mean, going through your thesis, kind of your key criteria, is there anything I kind of missed, or you can also give kind of the
right. So what I would say that there's a couple of investment buckets I usually look into. So I would say that there are your very cheap, high quality growth stocks, but there's usually a reason why they're cheap. That's my favorite hunting ground. And as I said, there's usually a couple of reasons why they'll be in that bucket. It's either because it's got hair on it, there's a problem today, and the market can quite often say, I think this is a permanent problem, and maybe it's temporary, but that's a judgment call. So there's plenty of companies which they will go out of favor, but the actual business quality is very high. There's another bucket which is within the small microcap undiscovered, and it can be, as I said, undiscovered for a whole bunch of reasons. It's just not a lot of people haven't heard of this company. It's been under the radar. It's either new, it's under the radar, it's small, or something like that. So that's the reason why I will attend or bunch of these conferences, meet lots of these different companies. And what I would also say is that the companies can fit into that bucket of being capital light with high growth, but have an existing core business which doesn't necessarily fit that. But there's a lot of incremental revenue coming through that will be like that. So that's actually my favorite investment bucket, where there's all the growth is coming from really high margin, high cash conversion, and it's going to transform the financials of the entire company. Because usually what happens is that the stock market will value these companies the way that they already are and won't necessarily look forward to what's it going to look like. So I will very much focus on what does this company look like in 2 or 3 years' time? How much am I paying for that today? And how much do I think that's realistically worth in the future? And so that's what I find quite a lot in these small micro-cap bucket, particularly where there's a change in the business. So trying to think of an example of a company like that. So my biggest position is in IWG, which is not a micro-cap. That's it's a $2 billion company, but they have all these offices which they release out. But their new business, which is growing like a freight train, is a managed and franchise business where the margins are astronomical and those royalties all drop through to the bottom line. So that'll be an example. The last write-up that I did was on PLBY, PLBY, which you hosted, the CEO, and I hadn't looked at that for a really long time. And the last time I looked at it was when it IPO'd as a SPAC, and I didn't like the look at it at that time. But what I realized from listening into your interview and subsequently following up with the company and etc. was that there was going to be massive revenue coming through from these royalties, which were going to be very sticky and very long life with growth. And so when you start modeling it all out, it was, oh my gosh, this could be on 3 times cash flow and be or 3, 4, 5, whatever it is, and it'd be a 100% royalty business. Those businesses are worth a lot, particularly if they're growing. But because the business went through such a drastic change in the last year, where people's memories are tied to what it used to look like, it's fallen under the radar. No one's writing about it. No one cares about it. And so it's trying to find those stories where there's a change, where the business on a forward-looking basis is going to look really good. So I own PLBY and IWG, but an example of one which I don't own today, have in the past, is McCoy Global, which, oil and gas, not that on the surface of it doesn't look that exciting, but it's very technology based, and they've got these new products coming out, and the products are going to be, for all intents and purposes, autonomous. But to have them to be autonomous working together, you need to own the software package. So if you've got half the revenues which are from replacement parts, some of it's coming from software, then you start looking at it, oh my God, this is a big recurring revenue stream, which is all that software is massive margin, and the base business didn't used to be. That's going to be worth a lot, deserve a higher multiple, and there's going to be earnings growth. So, it's trying to sniff out those types of changes where you're going to get earnings growth, and you should get a big re-rating in the stock where the starting multiple is quite low. So that's sort of like the meat of the situation which I get excited about. At the other end of the spectrum, I also like situations where I call them like listed VC. So slightly, maybe the business is unprofitable today, it's higher risk, higher octane, but the unit economics look really good. And if things pan out the way they think they do, these things could be 10 plus baggers. So it's sort of like a barbell approach where you have these cash generative growing companies which are cheap with these higher risk, but if it works, it's really going to work types of situations. So a company maybe in that bucket that I own is Comstock, where it used to be a precious metals miner, and they have two interesting technologies which they are in the process of commercializing. And if either of them work, it's going to justify a multi-billion-dollar market cap where the thing's trading at sub $100 million. And so in those types of situations, there's obviously more risk, but as long as you're going into it with your eyes wide open, that's okay. And in those situations, I'm probably going to do more on the ground due diligence. So for Comstock, I'm going to fly over to Nevada and go and see the metals facility, for instance, and see how everything's working and kick the tires on it in person. I've done a similar thing in ASP Isotopes, which was a microcap. Now it's a lot bigger, but I flew down to South Africa to see it for myself. So those come with higher risk, but potentially higher rewards. So I'm okay with those types of situations. And I've also done a fair amount of stuff in warrants and special sits, litigation situations with a similar kind of high risk, high reward payoffs, but you size them accordingly, and that's okay. I think a lot of people aren't comfortable with when there's a prospect of you are 70% likely to lose all your money. Most people just say, "Hey, not for me. I am out. No chance." But if there's a situation where there's 30% chance where you make 30 times your money, well, in my head, that's a great payoff. I will do that every single day, and I'll have a bunch of them size small, and I'm okay with that. But a lot of people aren't.
So do you, I mean, just thinking from your like with your situation, right? Like you have the music royalty business, right? That's kind of cash flowing. You probably could live off that alone if you were just doing that. Do you feel like that kind of plays a hand in that risk assessment that you play? Definitely. When you're like, right? Like, cause now you're like, this is, I'm just having fun right now. Like I'll do the extra work. I don't want to lose money, but I got this, if I lose here, like, all right, okay. Took a shot, did my work, but I got money.
Yeah, that definitely. I think that it allows you to think very unemotionally. If there's a drawdown, whatever, it can help take out the emotional swings, and you can be a lot more relaxed about the volatility, which is hard to be if you are really dependent on needing that nest egg. So yes, it definitely desensitizes you to some of the daily swings. I've definitely,
it's a great position to be in, don't get me wrong. Like as a microcap investor, it's an amazing position to be in, where you're like, sweet, like I can just take a couple swings. And it's not that you're not doing the work. I mean, please, you come flying all the way from UK to come to Vegas and Vancouver, do all these conferences, so it's not like you're not doing the work. It's just definitely after having done the work and being in that situation, it definitely helps.
Yeah, and also I think there's different people have different risk tolerances. So I probably have a lot higher risk tolerance than most people. So that's I always have done, and I think if you have a job where you have recurring cash flows coming in, then the worst thing that can happen is that whatever you're investing on the side doesn't work out, and you still got those cash flows coming in. So it definitely helps a lot. Where some people will say, you're crazy. How can you have X% of your portfolio in these listed venture bets or warrants or these litigation stubs? It's like, well, most of it's actually in these cash flow generative compounders, and yeah, there's a decent slug there, but I will think about it quite holistically in the context of you've got all the music stuff alongside the listed stuff, and it provides ballast.
No, absolutely. So I mean, look, what you answered part of this next question. Depending on the name, you might do some more on the ground due diligence, like you said, with some of your in the bucket of listed VC for like Comstock. You went to all that kind of stuff. But what other checks do you have in place for your thesis? Because I mean, look, just having gotten to know you're fairly optimistic, dude. So I mean, so like, what do you put in place? Like, all right, like here's where my entire thesis goes to hell.
So I think the starting point is you got to be able to understand what you're dealing with well enough to be able to poke holes in it and to stress test and ask the right questions. So I would say that there are certain sectors and areas where I'm not going to be able to get in my head. I need to be able to frame the risk reward profile appropriately. And if it's something which I don't really understand or can't really get my hands around, I will leave it alone. So it's almost easier to rule some things out. And that I think is quite important. So knowing where you're comfortable, and sometimes you've got to learn as well, but that's sort of check number one. I think part of it is trying to frame the risk reward profile with what can go right and what can go wrong. So if let's take an example. Let's take Comstock, for instance. The way that I will look at it will be very different from some of these cash flow compounders, because the cash flow compounders, I'll be modeling it out with a high degree of confidence, being able to frame it's going to generate this amount of cash flow. Worst case scenario, they can't find something to do with it. They buy back shares. I can work out how quickly the cash flows are going to grow on a per share basis. What's the multiple? And if I've got the forecasting right, then I can be relatively relaxed. It's about a timing and waiting and just making sure that nothing drastically goes wrong. With something like a Comstock, for instance, which is a slightly complicated piece. So for those who aren't familiar with it, they have, I would say, call it four different businesses. You have they have their legacy mining business, which is called a precious metal gold miner in Nevada. For all intents and purposes, we'll ignore that bit. They have they own a bunch of real estate in Nevada, which historically wasn't that valuable, but because of what's going on with AI and data centers, that's actually now quite valuable. But that's hard assets in the ground. You then have a third business, which is the metals bit, which is they will recycle solar panels. So these solar panels will come in. They have some technology which allows them to strip the solar panels, extract the silver, the glass, all the raw materials, which they then go and sell. And they also charge whoever owns a solar panel, because they would otherwise have to send it to a landfill. So they get a fee for that, and then they can sell the recycled products, and they make a very juicy margin. And then they have this energy, it's called Bioleum, which effectively enables them to do biofuels using waste wood. And they have some technology there which could be massive if it works. So being honest, I know that I can, with a high degree of confidence, work out roughly how much the land is worth. I can take a view around the metals recycling bit, because they have a facility, it's been going for a year, and they're building a new one which is coming out next year, and I know how much money they make, and it's not too much risk there. And then there's this big moonshot thing which could be worth a massive amount. And I'm not I'm not an engineer. To be able to really pick apart how valuable that piece is and stress test it is beyond my competence. But if the stock is trading at $100 million, and I know the land is worth $100 million, and I know that the mining assets which they have is worth something, and I know that the metals bit is probably going to generate, tens of million dollars in profit within a year and a half, I can treat that as a call option. And so even in those situations where you can't pick apart everything precisely, as long as you're comfortable with assessing the risk reward and what am I paying for what am I getting. As it happens, that energy bit called Bioleum, they've just taken in an investment at $1 billion valuation for just that little division. The market cap is under $100 million, and that's just one division. So it's like, okay, well, maybe that thing is worth $1 billion, but maybe it's not. But either way, it's a free call option because I can be confident on these other streams. And the more that you speak to the management team, you can get a feel for how they think about things and what they're trying to do. And some of it's building confidence with, is capital going to be managed appropriately by these management teams, and are they doing things sensibly? So anyway, that's a long-winded way of like, how can I get comfortable investing in these high-risk situations? It's just all about being able to assess the risk reward, but you can even do that even when there's pockets of blind spots.
100%. And you know what, in stories like Comstock and I'd say even PLBY and I can think of like 10 names that have very similar situations. Like, you don't really understand, you can see what's out there. Obviously, you see the stock price, you can do your valuation just based on that, but you really don't fully understand until you actually really look under the hood and see, all right, what are all the assets that make up this company? Because sometimes you just don't even realize. Like, I'm sure some people look at Load and like, wait, what? Like that.
Yeah, for sure.
That's what this.
I was one of them. Frankly, it was only Chris.
I'm not a shareholder, but I'm just
saying. Yeah, it was. So some of the idea generation comes from speaking to other investors. I went to a conference, met Chris Abbott in person, who had been chatting with, online for a while. And it was him who said, look, you've really got to look into this. You've really got to look into this. And over time, he wore me down, and I did. And I got quite excited about it. So, and that's how some of the idea generation comes about. And sometimes in terms of unpicking things, sometimes it's also seeing what other actors are doing. So if you take the example of PLBY, one of the reasons I got quite excited about it was there was all these big changes happening in terms of this big licensing deal. And the partner that was signing Byborg, this big licensing deal, which was taking all the adult entertainment assets, they agreed to buy almost 30% of the company at what was 50 to 100% above the share price. And you're like, well, why are they agreeing to do that? And if you read into the contract, it was, well, if when they have it and they make a certain amount of money, PLBY gets the higher of a fixed royalty or 25% of the profits. So I started thinking, well, they're probably pretty confident they're going to have to pay PLBY more money than the minimum guarantee. And if that happens, this stock is insanely cheap. And so that it was those types of, what are the insiders or other players that have better information than you? What are the signals that you are getting? And that's happened in Comstock with these Marathon buying at a valuation into one division at multiples of the share price. In PLBY with Byborg buying, wanting to buy as many shares as they could. And some of those signals are quite powerful. And you have to dig under the hood to pick these apart, because particularly in the microcap sphere, unless the best opportunities are usually where other people aren't looking very intently.
No, absolutely. I mean, one big theme for you that you look at is Dispacs. Go for it.
One of them.
Yeah. I mean, you kind of cover quite a bit of it, but I mean, like that's. Geez, I mean, like opportunity.
Yeah, because I think the Dispack Universe is, I think there's quite a few Dispacs which I own shares in, but some large cap, some small, and everything in between. That is an area that I've found systematically is underanalyzed. So, being involved in warrants, that's where a lot of these warrants will come from originally. So that's how I got to know the universe quite intently. But it's a strange place where you will have companies which are worth billions of dollars, but they are as underfollowed as companies with $100 million market cap. And for me, that's interesting to the extent that the company, there's something good going on with the company and there's a positive change. So when you can identify positive change, there's a longer window where it can be going on before people wake up to it. And that's what I'm trying to find usually is positive change. The company's going to look really attractive. The business mix is going to get better a couple of years out, but people aren't paying attention. So whether that's buying the stock or the warrant, there's plenty of different ways that you can do it. But I would say de-SPACs and microcaps have got quite a lot of overlap in that undiscovered opportunity sets. Even though I would say a lot of de-SPACs are rubbish companies. So you're trying to find the exceptions to the rule, not
right. No, it's not so much undiscovered; it's more Left 4 Dead.
Exactly. The Left 4 Dead, the Left 4 Dead bucket is great if there's some positive change going on, but most of the time there isn't. Right? It's sort of, I would say, 80 to 90% of the time there isn't. But it's that all you need to do is find a couple of these things where things are inflecting and they're getting better, and where the management teams are doing sensible things, and there's a lot of money to be made, but things could go wrong too. So it's nothing's guaranteed.
100%. Um, Another question I love asking everybody on here, and you've given some great stories already, great examples. But what would you say was an investing experience in microcaps that really changed your career, changed your focus, or kind of put you on the path that you're on today?
Um, hmm. I would say it's definitely not a microcap now, but and it wasn't a microcap when I first invested in it. But the one which was the most transformational for me was probably AST Space Mobile, which was a DSPAC. I think it was originally $1 billion. It fell all the way to $200 million. Bar maybe 6 months, I've been invested in it. I've been invested in it from the year 2000 all the way through to today. There was a 6 month period where I took profits, but I think today it's now worth $10 billion. And that was a lesson in on the downside, right? Because initially it worked out well and then it crashed. But really, the thesis is pretty much been the same throughout. It's just been de-risked along the journey. This was in that sort of listed venture bet component. If it works, it's worth tens of billions, maybe 100 billion. And if it doesn't work, you're shit out of luck. And yeah, it was a lesson in a lot of things in terms of the thesis has been the same all the way out. But the share price has moved around a hell of a lot. So it was a degree of being underwater, the stress of okay, I'm down like 80, 70, 80%. Do I still want to re-underwrite this? How do I think about it? Et cetera, et cetera. It went to being the smallest position in the portfolio to, within a 2 month period, it went from 20, 30 bagged in a month in the warrants. And that was life changing. But it was also a lesson in that you've got to be able to withstand volatility. You've got to be able to really be able to understand the risk that you're taking on, what can go right and what can go wrong. And some of this is to do with psychology, and sometimes things don't pan out, right? And so that went from being a microcap to a large cap now, right? Even though there's still a lot of things that need to happen. And that's what those situations is what I'm looking for in that high risk level of the spectrum. But by God, it can definitely cause you a bit of stress along the way.
Gosh, to say the least. Man, those 70-80% drawdowns, that'll have anybody checking their heart rate a little bit. But
it's definitely not for the faint-hearted. But you've got to, some of it's how you size these things. And I think at the time I probably sized it originally way too big, and so some of that emotional component kicked in, and it all worked out well, but it was a bit of a baptism by fire. You don't typically, if you buy stocks which are cheap and are generating cash flows and the cash flows are growing, you shouldn't have those sorts of extreme drawdowns generally. So I try to have certain names and certain buckets where, that's okay if it falls 50%, because I know it's going to be volatile and it's either going to work or it's not going to work. And versus the other compounding types where the risk profile should be a lot smaller and really should be more comfortable about sizing those up. So usually when I'm initiating positions, the ones which I'm happy to be big are those cash flow compounding ones. But if these high risk listed VC type of names work, then they can organically become big positions. So which is a good problem to have.
Absolutely. Jerome, you've given me a lot of time here today. I really do appreciate it. My final question for you here, for those that are, just wanting to take more risk and, starting to kind of maybe make more higher risk bets, what advice would you have for them other than the obvious of, don't bet more than you can afford to lose?
I would say sizing is important, and Sizing is important. So you almost need to frame it as how much money are you prepared to lose, or how much, because the worst situation is you have a drawdown, you not be able to weather the storm, and you emotionally or otherwise end up cutting it. So size things appropriately so that if you make it a 2% position, that you're good, you're going to have the staying power to ride it out, instead of making it a 20% position where if it halves, you're going to feel very emotional about it. So that's one. And I would say just be very selective. So with these high risk bets, the filter which I like to apply is at maturity, or call it 3-5 years out, or whatever it is this a good bit? Are the unit economics good? So I will typically try to find the companies where, if it works, for instance, it's going to move to a licensing model, and where the margins are going to be really high, and it's going to be a very juicy, high multiple business, as opposed to, I don't know, something like a direct to consumer online business where maybe they sell a whole much more stuff, but the margins are going to be small, and there's more risk in that. So that's how I get more comfortable, is trying to find these disruptive businesses where if it scales, it's going to be wildly profitable, instead of trying to make the high octane bets where even if it does scale, it's going to be a average or less than average business.
Very good. All right. This is a great place to end it, Jerome. I'm sure I'll have you back on for your next, D-SPAC idea that you have to find at a Blended MicroCap event. But with that, where can everybody go and follow you on social media? Obviously, there's at Uzo Capital, but is there anywhere else that you want folks I'm on Twitter or X, so at Uzo Capital. My DMs are generally open. I'll respond to people. I'm happy to interact with people. I've got a lot through that platform over the years, and I'm also in Substack. So maybe about once, maybe twice a quarter, I'll decide to write up an idea and share it. And I do that really to get feedback and get up the learning curve myself. So but you can reach me there too, Substack or Twitter, or X as they call it nowadays. Very good. All right, well, Jerome, thank you so much for joining me today. Really do appreciate it. Good luck. Stay safe. And I guess I'll see you at the next conference.
Indeed. I'll see you in
Toronto.
Indeed.
Very cool. Thanks, man.
Take care.